Hello everyone, it's Friday, August 29. Today we're analyzing the euro and British pound charts to gauge potential market moves. The European currency has modestly recovered from a correction during the Asian session. Yesterday the euro posted solid gains, which was a surprise given that US data. Particularly second quarter 2025 GDP was revised higher. Growth came in at an annualized 3.3% compared with the initial estimate of 3.0. By contrast, in the first quarter, GDP contracted at an annual rate of 0.5%. Yet the stronger reading failed to trigger sustained dollar buying. The greenback briefly attempted to rally, but gains quickly faded. In the near term, the bullish trend in the euro-dollar pair remains intact, with traders awaiting today's US statistics. Most likely, market choose to discount yesterday's upbeat figures, including a decline in initial jobless claims in favor of dovish signals from Fed officials. Recently, policymakers have increasingly emphasized the need to cut interest rates, reinforcing expectations of the first rate reduction of this year at the first September meeting. Turning to today's macroeconomic calendar, a batch of Eurozone data has already been released. French data came in at weak, shifting market focus to Germany. Europe's largest economy reported a decline in unemployment persons, while the unemployment rate held steady at 6.3%. Attention now turns to Germany's consumer price index and, more importantly, the US core personal consumption expenditures price index, the Fed's preferred inflation gauge. This release is expected to shape the Fed's September policy decision. Notably, the core PCE index has been edging higher since April, 0.1% that month, 0.2% in May, and 0.3% in June. July's reading is projected to remain at 0.3%. On an annual basis, the measure is forecast at 2.8%, unchanged since May. A sharper than expected rise would likely revive demand for the dollar, prompting end-of-week sell-offs in the euro and pound. Conversely, a softer reading would give the Fed room to deliver at least one rate cut, pressuring the greenback and opening the way for further gain in the euro and British pound. Also on the radar are the U.S. goods trade balance and the University of Michigan's consumer sentiment and inflation expectations indices. Still, these reports are of secondary importance, so the spotlight remains firmly on the core PCE index. Now let's turn to technical analysis. On the EUR-USD chart, a decline followed by a false breakout at 1.1658 would generate a buy signal, sending the euro towards 1689. A breakout and firm consolidation above these levels, especially against the backdrop of weak inflation data, could extend the move to 1.1717 and potentially open the way to 1740. At this level, I would recommend going short on the rebound, targeting an intraday correction of 20-25 pips. Short entries at 1.1689 and 1717 should be considered on a false breakout. If upside momentum fizzles out at 1658, it would be prudent to delay long positions until 1631 on a false breakout, or 1604 on a rebound, aiming for a corrective move of 25-30 pips. As for the British pound, it remains under pressure amid a light UK macroeconomic calendar. A false breakout at 34.85 would generate a buy signal, allowing sterling to climb toward 35.23. A breakout and consolidation above this level following the release of US statistics could open the way for further gains to 35.60 and potentially 1.3587. At this mark, it would be wise to go short on the rebound, counting an intraday correction of 25-30 pips. Going short at 35.60 and 35.23 would only be relevant after a false breakout. In a bearish scenario, if the price remains below 34.85, sterling would likely come under heavy selling pressure, sliding to 34.52. Stronger US inflation could deepen the decline, pushing the pound to at least 34.19. This level would present an attractive opportunity for long entries on the rebound, targeting a corrective move of 25-30 pips. Long positions at 34.85 and 34.52 would be prudent in the event of a false breakout. Good luck and enjoy your weekend.